Okay, well, good afternoon, everyone, and welcome to the fourth talk of this year's series of What Economists Really Do. My name's Abi Adams. I'm a professor of economics in the department and associate head for external engagement and research impact. Now, this talk is a special one for us as it's sponsored by EBC Financial Group as part of its commitment to make economic research accessible to the public and ensuring that we all have a clear understanding of the relevance of economics to our daily lives. And the funds as part of this sponsorship package are being used as part of the department's graduate scholarship fund. Now, I'm delighted to introduce Sarah Clifford, who's an associate professor at the department, and she's going to be giving us some insights based on her research into the economics of corporate tax evasion. And to complement her insights, David Barrett, who's the CEO of EBC Financial Group, will provide his insights from an industry perspective, building on his extensive financial industry experience in global institutions. And so I should say before kind of a little bit on the logistics that the views spoken as part of this webinar don't necessarily reflect the views of the Department of Economics. In terms of the structure of this webinar, Sarah's going to speak for about 25 to 30 minutes before we hand over to David. And I'll be aiming to leave about 15 minutes for Q&A at the end of the webinar. So please, as your questions come to you, do add them to the Q&A function on Zoom. And so I can do my best to organize themes as best as possible so we make sure all of your questions get posed to our very experienced and distinguished panelists. Now, with that, I will stop talking and hand over to Sarah. But thank you again.
All right, thank you. Thank you so much, Abi. Thank you very much for the invitation and for the introduction. I'll do my very best to stay within time, but do let me know if I run extensively over. We want to have time to also hear David's perspective. So yeah, I guess in the interest of time, let me just jump straight into it. So I want to start with just a little bit of reflection on what tax evasion really is. So I think if you ask a random person on the street to give you an example of tax evasion, the example that they're going to come up with is likely going to be something reflecting fraud, sort of outright fraud, something that's clearly illegal. That could be not declaring your self-employment income on your tax return. It could be hiding interest income abroad or something that's clearly legal. But there's a lot of other actions or practices that fall much more in a legal gray zone. So that could be things like firms shifting profits to shell companies, and those shell companies not having any or very little economic activity. It's hard to say if that is exploiting differences in the legal systems across countries and the different tax systems, or if that is reflective of fraud. And so I think there are a lot of practices here where it's unclear what the outcome would be in a court of law. But the common factor here is that all of these types of activities lower the tax burden of the economic agents in a way that's intentional, so on purpose. And so as economists, we can sort of abstract from the legal uncertainty a bit, leave that up to the lawyers to a certain extent, and think more in general about practices that lower the tax burden of taxpayers in a way that's intentional and also in a way that's not clearly legal. So that's how I want you to think about tax evasion in the context of this presentation, as a bundle of practices that lower the tax burden of economic agents on purpose. So why is this important? I think that's important to start with thinking about why this is an important topic to consider. So the first thing that comes to mind, I think, is revenue. So one of the key reasons why we have taxes in the first place is because governments need funds for lots of important things like funding education or health. And the revenue implications of tax evasion can be very large. So I'm going to show you some examples later on. And of course, this depends on the tax base. We're looking at the tax instrument, the context, and so on, but they can be very large. At the same time, you also have very large enforcement and compliance costs. So because taxpayers don't just pay their taxes when you ask them to necessarily, some people do, not everyone, there are large efforts by tax administrations to monitor, to audit, and all of those things are very costly. On the side of the taxpayer, you also have lots of costs of coming up with documentation, abiding by the law, knowing the law, which can be very complicated in some context. And one issue that's been highlighted, especially in very recent research, is equity implications of tax evasion. So a key question here is who can evade taxes? Because it's not clear that the distribution of tax evasion is going to be completely homogeneous across the distribution of income, for instance, or wealth. And so if that is not the case, and there's some evidence, some recent studies showing that especially some types of practices can be very concentrated at the very top of particularly the wealth distribution. Well, that means that tax evasion can potentially undermine an intended progressivity of the tax schedule. Now, it's a political matter if you want a progressive tax system, right? But to the extent that governments want that, that can really be undermined by tax evasion. There are also issues of trust in government, social cohesion. If you're seeing your neighbor evading taxes, it's a natural question to ask, why should I contribute if other people don't? And so this is really fundamental for well-functioning democracy and social cohesion. One thing I also just want to highlight is that tax evasion is very intimately connected with tax policy, right? So tax evasion can materially impact how we structure our tax system, the types of tax instruments that we're relying on. And one example I just want to give you here is from a recent paper by Anders Jensen, showing that if you look over the development process of countries, you tend to see that countries become more and more reliant on the personal income tax as opposed to other taxes such as tariffs or corporate taxes as they develop. And the question is, why is that? To a large extent, he shows that this has something to do with tax evasion. This is because as countries develop, of course, lots of things happen, but one of the things that really that we see happening a lot is that these countries transition from being heavily reliant on self-employment and being more characterized by being an employee type economy. And that makes it a lot easier to enforce the personal income tax, which then expands the use of the personal income tax. So this really has implications for the composition of tax instruments. Now, there are many different dimensions of tax evasion. I'm not even going to try to cover everything here. You can think of different tax instruments, different agents, and so on. But if you think about the types of behaviors here that are involved, there are broadly two different dimensions that we can think about. So we can think about onshore tax evasion, by which we mean things that, so types of behavior that does not exploit differences in tax environments across different countries or the legal framework of different countries. So in some sense, this is behavior that happens within a single tax framework and then exploiting loopholes within that or just not complying with those tax rules. And so examples of that could be individuals not declaring their self-employment income, firms that are not incorporating and operating in the informal sector, and so on. As a second dimension here, you can think of offshore tax evasion. So these are really types of behaviors where taxpayers take advantage of the fact that you have differences in tax systems across the globe. We can think of examples both in the context of individuals and in the context of firms. So there's some recent evidence showing how very wealthy individuals have historically been hiding assets in offshore tax havens, for instance. So you think about Swiss banks, which have historically been very popular here. That's changed quite a bit recently, and as part of a big set of policy interventions that's really happened in very recent years. but yeah, there are studies looking at those types of behaviors. On the corporate side, you can think of large multinational corporations shifting their profits to low tax jurisdictions, or what we could call tax havens. So I'm going to use the term tax havens a bit here. In some contexts, they're called investment hubs. You can, in general, think about environments or countries, jurisdictions that offer low tax rates on some tax instrument. Some of them can also offer some secrecy, like bank secrecy and so on. But think about it more as low tax environments. So this could be, for instance, Ireland, Bermuda, and so on are prime examples. So what are some of the challenges that we have when we as economists try to study tax evasion? Well, there is one key issue, and that is that you're trying to study behavior that people are actively trying to hide very often. And that makes it very challenging because you can't just go out and ask people, so how much are you evading on your taxes? At least you can't expect to get an honest answer in many contexts. So it's very likely that firms and people are not honest in surveys. Even if they're anonymized, there might be concerns about increased enforcement efforts if you have a survey that shows large amount of evasion and so on. So that's really hard to use surveys. We can use audits and audit data. And there are a lot of really great studies that have done that and looked at different dimensions of the tax schedule using audit data. There are also challenges with that. For instance, it's very hard to, even in audits, to discover all tax evasion, because essentially even an auditor needs some documentation or information to be able to compare tax returns and actual behavior. And if you think about the context of offshore banks, for instance, and where we historically have had a lot of secrecy and not exchange of information, the auditor wouldn't even be able to see those assets, right? And so it would be very hard to even measure that using audits. But because of these challenges, this is also really a super interesting literature, because this literature has then come up with a lot of really creative ways of trying to measure non-compliance because of these challenges. And I just want to give you a couple of examples before I move on to talk more about corporate evasion in particular. So there's this really cool paper from 2016 where they use the fact that banks in Greece basically have this algorithm to try and predict true income of their customers based on their experience with people defaulting and how they perform on their loans. And so the idea in this paper is really to use this algorithm that predicts people's true income to say something about underreporting of income, because a bank has all the incentive in the world to try to figure out what people's actual income is. And they come up with a number of around 40% of self-employment income being underreported. So quite extensive. Another example of a very creative approach is to use these data from these leaks. So I'm sure many of you will have heard of Panama Papers, Swiss leaks. So in the context of Swiss leaks, this was a big bank in Switzerland, and the entire customer base and all the accounts were made public. And by matching that to administrative data, you can really get a sense both of the extent, of course, of evasion using this approach, but also how this looks across the distribution of wealth in the countries where you have this tax data. And so I think these are some of the really creative and interesting ways of going about this. In the interest of time, I'm gonna, for the rest of today, focus only on offshore corporate tax evasion. But I hope this has sort of given an idea that there's a lot of things out there. There's a lot of really interesting papers on multiple aspects of tax evasion. So just to make sure that we're all on the same page, just briefly, how are corporations taxed? So for the rest of this talk, I'm going to focus on corporate income tax. So basically, the tax that's charged on firm profits before they're paid out to shareholders. Now, the way the system functions, broadly speaking, so there are a lot of complications on that, but broadly speaking, each country taxes the profits of firms that's booked there. That means that when you have big multinational corporations, they are taxed in multiple different countries by multiple different tax systems, different tax rules, different reporting rules, and so on. Largely irrespective of the location of the headquarters. That's not totally true, but we can we don't have to go into that for the purposes of this talk. Now, this means that this system is very vulnerable to globalization, right? Because it creates incentives to do business where taxes are lowest. And to the extent that you have a reason for doing business in a certain place, so let's say you want to have your production, manufacturing, research and development in a certain country, it really creates incentives to try and separate your profits from your activity and move that profits into areas where it's taxed at a very low rate. And that's what we often refer to as profit shifting. So moving profits without necessarily moving activities. Now, there are a lot of other taxes that are important for firms that I'm not going to talk about here, but that would be interesting for another talk, another day. So by profit shifting, we mean this tax-motivated artificial transfer of paper profits to low tax jurisdictions. The literature has broadly identified 3 ways that this is being done. So I'm sure there are other ways, but these are 3 of the very important strategies that multinational firms use. And so I'm briefly going to go over them just to give you an idea of what are the types of behavior that's involved in this. And then I'm going to talk a little bit more about the measurement of the magnitude of this. So just briefly, one key strategy that has been used is manipulation of intergroup trade. Now, because you have different divisions or affiliates of a multinational group, and they are located in different countries, but they are owned by a parent that can essentially decide on the amount of trade, the trade prices, that means you have scope to manipulate the amount of trade and the prices at which this happens. And so if you think of a situation where you have a tax haven affiliate that exports a service to an affiliate in a high tax country at a very high price, that's going to move profit into the low tax country and out of the high tax country. The higher you set the price, the more it's going to be moved. Now, in principle, that's not supposed to be possible, because in principle, we have a central principle called the arm's length principle, which states that trade within a multinational group has to happen as if the parties were unrelated. Now, the thing is that that's very hard to monitor, because very often trade is happening in things that are very hard to price. So if you think about a financial service, for instance, the price of that really depends what the service is and how competent the service was given and so on. And so that can be really hard. And there's lots of evidence showing, empirical evidence showing that if you look at prices within related parties, they tend to deviate quite a lot from prices between unrelated parties, and that tends to be very correlated with tax differences. You also have empirical evidence showing a lot of trade in specifically these financial information services from low tax jurisdictions. The second main strategy here that's been explored quite a bit is the strategic placement of intangible assets. And that's really related in a way, but essentially it relies on the fact that if you locate intangible assets in a low tax environment, all the income that accrues to that asset is going to be taxed in that country. And so if a prime example here is a patent, if you have a patent within your group, let's say Google has a patent on the search algorithm or something like that, if you locate that in Bermuda, then all the other affiliates of the multinational group is going to have to pay royalties whenever they use that algorithm, and that income is going to end up in Bermuda. Of course, you need to transfer that intangible asset in some way, which if you look empirically, typically happens either through a direct sale. So if you look at the sales of patents within multinational groups, 30% of them have a buyer in a tax haven. So it's really something where you see these stark patterns. You can also do it via cost sharing agreements and so on, but that's maybe less important. The last strategy is intergroup debt. So because interest payments on debt are typically tax deductible, but the receipts of those interests is not, that means that if you're an affiliate in a high tax country, you take a loan from an affiliate in a low tax country, you have to pay interest to that low tax affiliate, and that's going to be tax deductible in the high tax country, and it's going to be taxed in the low tax country. So that's a different way of moving profits. And you see extensive empirical evidence in the literature that debt is very tax sensitive. So when you change tax rates, debt reacts a lot. And also, if you look at affiliates in high tax countries, they tend to be very highly leveraged in line with this type of approach or strategy. Now, this raises at least two key questions, maybe many more. But one key question is how much profit actually moves. So is this something that we should really care about? Because of course, this is not all firms, right? So how many is it actually, and how much is being used? And what are the implications for tax revenue and for our ability to tax corporate profits? There are multiple ways of going about that in the literature. One way is to try and measure the tax sensitivity of corporate profits. So using, for instance, tax reforms or other exogenous shocks to earnings. And based on that, predict the overall volume of this. Another approach is to try to find firms that we don't think have the ability to profit shift, mainly because they are located in only one country. And so the prime the prime type of firm that's used here for comparison is local firms. The idea being that multinational firms have the ability to exploit these differences across tax systems, local firms do not. And so if we compare the profitability of these two types of firms, that's going to tell us something about the extent to which this is happening. There's literature doing this within countries and literature doing this more on a global scale using macro statistics and largely macro data, actually. So I'm going to show you a couple of pictures from this last group of papers. So this is a very recent paper that tries to measure the global amount of profits that's being shifted, and also what are the revenue implications for certain countries of that shifting. So they start from the observation here that if you look at the profitability of foreign firms and local firms, foreign firms are hugely more profitable within tax havens, but they are not hugely more profitable within higher tax environments. And so here profitability is measured as corporate profits as a share of the compensation of employees to try and account for the fact that there is some real activity happening here as well. But it's just it's quite striking how much more profitable these foreign firms are. And if you, of course, you need to take account of a bunch of things here. So there might be differences in industry composition, in the type of activities that these firms are doing. But even if you account for these types of things, this pattern just doesn't go away. You still see these massive profitability differences. So the methodology they use here is to some extent simple. They compute what foreign firms in, for instance, Ireland, or it could be in any other low tax environment, would be making if they were as profitable as as local firms, essentially. So what would be their profitability if they were not multinational, but if they were local? And we can take the difference here and sum that up across all these different low tax environments. And that gives you an estimate for 2019 of about $1 trillion being shifted in profits to these low tax environments or tax havens. So to give a little bit of perspective, that's about 37% of global multinational profit. So profit that's located outside of the home country. It's about 6% of global corporate profits. And if you relate that to the revenue implications, then that shifting or that activity represents a loss of about 10% of the global corporate tax receipts. So it's something that's quite sizable globally, but of course it's heterogeneous which countries this affects the most. And I want to just say that, of course, when you have these very country-specific estimates, we should take them with a grain of salt because this is macro evidence. So these are indicative but not determinative. But basically what this graph is showing you is if you assume that the amount of profits that's located in these low tax environments, that can be attributed back to where they came from in proportion to cross-border payments that are conducive of profit shifting. And these are the type of payments that I was talking about before. So intragroup interest, movements of patents, and so on. If we look at where those payments are coming from and we attribute the profits in proportion to those payments, then the picture looks something like this. So the UK actually comes out as a country that has a big loss in tax revenue from this. So a lot of profit is being shifted out of the UK. In 2019, it was more than 30%. But of course, this is heterogeneous across countries, and yeah, the global average here is about 10%. Historically, I think there's a quite striking pattern that emerges. So what I'm showing you in this figure is over time, the development of this over time, essentially. So what's the corporate tax revenue, that's the black line, that's lost from shifting if we make additional assumptions because we don't have the same data and so on going back. So in this paper, they use other data sources, but it's broadly comparable. And I think it's quite striking that if you go back to the 70s, this just was not a problem at all. So this is really something that has materialized with financial corporate globalization and is now really high, or at least, I mean, that's debatable and you know what people think, but you know, personally, I would say that it's fairly high at the moment. Okay, I'm almost out of time, but I just want to briefly talk a little bit about some of the recent policy initiatives. So what has been done in this space, because I think this is a really topical area. There's been very recent policy initiatives that I think are super exciting, and it's really interesting to see in the coming years how this is going to change. So, of course, countries have tried to respond to this issue. So, and one way in which that can be done is using unilateral policy measures. So, countries have increasingly introduced what we call anti-tax avoidance rules. So those are rules that are particularly targeted at these key strategies that have been observed in the literature as being very prevalent. And those are unilateral in the sense that single countries can implement this rule to try and do something about these specific strategies. Now, one thing I want to note here as well is that because this is happening, this is becoming an increasingly complicated system. So the international corporate tax rules are super complicated, and there are a lot of compliance costs that I think we should take very seriously, and we need to think about as we put more and more policies on top of an already very complicated system. But you know, that's a discussion for another day, maybe. So those are unilateral measures. Recently, there's also been international coordination, because the issue here, of course, is that individuals and firms are taking advantage of the fact that you can find very different tax rates and very different tax systems across the globe. And so in 2015, the OECD launched this base erosion and profit shifting initiatives, what's called BEPS, which was an attempt to try and coordinate and get countries to get together and agree on a set of minimum standards in some sense, and agree to coordinate to try and confront this problem. So that led to, in 2021, more than 130 jurisdictions agreeing in principle to an outline of a new international tax reform. Part of that tax reform is what's called the global minimum tax. And I think it's a really interesting development, and it will be super interesting to see what's gonna happen with this. So essentially, the global minimum tax is a minimum tax of 15% on the profits of the very largest multinational firms. So this is only firms that have consolidated turnover above 750 million euros. So these are the biggest groups that we see. Now, you can imagine that it's very hard to get all countries on board with this. I mean, I wasn't in the rooms in the OECD, but I'm imagining this is not easy. And so the rules are designed in a way that they include a bunch of backstops in case there are countries that are not willing to implement them. So, for instance, if they're designed such that each multinational should be taxed at a minimum of 15% within each jurisdiction that they operate. But if you have a jurisdiction that's not willing to implement this minimum tax, basically the headquarter country can go in and tax that profit up to the 15% rate in that country. If the headquarter country is not willing to do that, then the other affiliate countries can have a share and go in and tax that profit in that jurisdiction. So it's really designed in a way to try to limit the impact of some countries potentially not wanting to join in here. More than 30, I think even 35 countries now have currently introduced draft or final legislation implementing this global minimum tax. And it's really starting right now. So the first wave of these countries have implemented it from January 2024. And that includes EU, UK, Japan, and a host of other countries. The OECD have tried to estimate what this is going to mean in terms of like what's the revenue impact going to be on this. And of course, this is super complicated because we have to predict how firms are going to respond, how countries are going to respond, all of these things. So there's a big effort by the OECD to try and do that. But they come up with an estimate of up to about 8% of global corporate income tax is going to be raised by this global minimum tax. And so I think like what I want to leave you with here is really the question of is this a game changer? So is this going to really change the pattern that we're seeing here? We don't know. So this is implemented just now. So we have no data, but it's going to be super interesting to see in a couple of years what are going to be the impacts of this. Is this really going to change how these things are happening? There are critics that are highlighting loopholes within these rules, and I certainly agree that there are ways in which that companies can try and circumvent them, and so it's not immediately clear whether this is going to be a game changer, but it's certainly going to be super interesting in the coming years to see what's going to happen with this. So with that, I'm gonna stop here. So we have time for David's perspective as well, and a bit of time for Q&A. So thank you.
Brilliant. Thank you so much, Sarah. We'll get to, I'm sure, more of this in the Q&A, but just the scale of some of the figures that you were showing, like always kind of just like, I find them staggering. David, I'm really interested to hear your thoughts, bringing a kind of a more industry perspective to complement Sarah's. So we've got about 10-15 minutes.
Sure. Well, I think all of those topics are really key to how the whole thing works in the real world as well. And I've kind of tried to break it down into some broad areas that we can think about. So if you think about competitive pressure, so all of these rules are there, globalization's happened, jurisdiction arbitrage has come in, and it's created a huge amount of competitive pressure. And the bottom line is that firms have to compete. So it's very difficult for them to stop competing with their peer group and remain competitive. And I think that there's a big distinction between large businesses and small businesses. Small businesses find the complexity of joining that world extremely expensive and extremely costly in terms of time management for their employees as well. Multinational companies can do this on a much broader scale. And the problem that they have is that if the small companies remain local, then it's very, very difficult for them to compete with companies that are global. So if you look at Amazon, they basically, for a period of time, you could argue they killed a bookshop, but they're killing everything else as well because they have that global reach, global advantage, and huge resource to cope with the complexity of a system that they've extensively built themselves. And they've been a big driver in how this has worked. And I think, most people that do compete in these environments see it as an extension of their business model. It's not something that they choose to do because it's fun and something they want to spend their time, effort, and money on. This is something that becomes an intrinsic part of what they do for a living. So, the competitive pressure on everybody from the big guys up to the small guys is very acute. And I think, the reality is that if everybody in your peer group is doing it, you just can't afford not to. It creates a loop, and that loop is constantly striving for creation of ways of keeping up with your competitors and getting around the system to keep that edge that your most advanced competitors have got already. I don't think there's any lack of correlation between the fact that the big guys have got bigger and the little guys have really struggled to keep going. And I don't think you can ignore that in the real world. The way that you have to look at it is that in all sectors, large companies are dominating their particular peer group, and there's no lack of coincidence in that. The fact is that they're able to compete at a different level. It's a bit like a sports team or anything else. They're just better at it because they can be. I think it's very easy to say that that's all unfair. It shouldn't happen. It's been allowed to happen and nobody's done anything about it. And, these companies have become monsters within their sectors that have become very hard to control. And I think that could be true depending on your political and economic point of view. But the fact is that it's real world, it's there, and it's a very active part of conducting business in the world at the moment. And there's no way around it. So if you think about, Sarah mentioned the complexity of what goes on. Globalization, once globalization started, the offshoring event and the jurisdiction arbitrage is almost like a natural extension of globalization. As soon as you let people operate in a broader arena, they're going to find ways of exploiting those parts of the arena that suits them. I think, most jurisdictions tend to have non-fungible rules, whether that's tax, whether it's employment, or whether it's regulatory rules. And firms that are engaged in these different jurisdictions have found that level of complexity quite daunting. And it's really not something that people have taken as a given. I think a lot of people think that it's an easy route to make themselves more profitable, but once you get in there, it's incredibly difficult to keep up with what's going on. And I think, one thing I would say from a business point of view is that countries enabled this, countries encourage this, and countries make a lot of money out of this. So it's very easy for finger pointing from the general public or even from the academic world at businesses for doing the wrong thing. But the fact is the system has evolved to allow them to do that. And there's lots of competing reasons why that's happened, whether it be government finances, political populist policies, or whatever it may be. But it's happened, and it's happened because governments have allowed it to happen. And I think it's easy to get lost in the look at what they're doing over their conversation and forget that there are a lot of jurisdictions in the world that are very, very happy to let it happen. The US has a whole state that's specifically designed, Delaware is specifically designed to help companies avoid the difficult things about operating in certain parts of the country or even taking offshore and going to other parts of the world. So you can't ignore that. And I think the other thing I would say is that the financial world, the world that I live in, particularly in some of my previous employers, we had tax groups. There were 4 guys that sat in the corner that understood the jurisdiction tax arbitrage, incredibly complicated, but incredibly profitable for the businesses. So this whole intra-group repositioning of where profitability lies, that was their bread and butter. They would manipulate balance sheets, they would manipulate companies and jurisdictions to allow that profit transfer to be put into places. And it was very, very profitable. I mean, I think one way of looking at it maybe is Occam's razor is a really good example, right? Occam's razor is all about don't take the hard way, take the most direct and most simple route. And for a lot of these people, the financial world has enabled that to happen. They give them solutions. Governments give them solutions and they go and do it. And if they don't do it, the share price doesn't perform and they don't get out of it what perhaps the shareholders, who are the ultimate beneficiaries, everybody with a pension fund as well as the people that own it, then that's what comes out of it. If taxpayers don't like what's going on, in my opinion, they need to vote governments in that are going to change it. And I think, it's very easy to do the finger pointing, but it really is in our hands as much as it is anybody else's. The system's a mess. It's hugely complicated. And as Sarah pointed out several times, that complexity, if you add things onto it, it's a negative feedback loop. It becomes more competitive. And if we think about tax havens, so tax havens aren't new. The New World was the first jurisdiction arbitrage that I could think of, and we're going back more than to post-war Britain and the Eurodollar market being involved. There were lands far away that had resources, commodities, and riches that governments over here wanted. They were inconvenient to travel to. They had hostile locals. They had plague, petulance, and all the rest of it. And governments encouraged people to go out there, and they did so by helping them avoid tax to keep their profits, and all of that was to help the governments that existed in the day. So, if you look at some of the exploitation of commodity wealth in Africa and Asia, it was all driven by New World pushing out and looking for new jurisdictions and encouraging people to do that. And the UK, as with most things in history, the UK's not exactly got a pure copybook either. So the 50s and 60s, we were responsible for the modern offshore jurisdiction. We invented, Midland Bank invented the euro market and Eurodollar market and exploited it with the government allowing it to happen because it helped them. They didn't have to use as much tax receipts. They didn't have to use as much of a government balance sheet. And a lot of these things could be encouraged to be done in a more efficient way. And I think, clearly paying tax or not paying tax is appealing. But the other thing about offshore is that it's also a regulatory arbitrage. So in the world that I live in, the regulatory arbitrage is as big a deal as the tax arbitrage, and they tend to come hand in hand. So modern financial markets look for jurisdictions that have low thresholds in terms of rules, low thresholds in terms of tax, accounting, regulations, and generally existing. So they run off to Vanuatu, the Solomon Islands, and all kinds of lovely places to visit. And they're doing that because it's an arbitrage, right? And they get the advantage of a tax arbitrage, but they also get wider business arbitrages as well, because the system has allowed that to happen. Now, I think something to take in account that counters what I just said is that big countries have worked out that this is a problem. So I think it ties in with Sarah's point about minimum global taxation and so on. They've worked out this is difficult. So they're now applying pressure to the poorly regulated regimes and the poorly regulated jurisdictions where people have flocked to. And they're making it difficult for those companies to exist outside of those jurisdictions. So, if you look at Lehman's, when Lehman's crashed during the crash in 07-08, Lehman's brought to the surface a very, very common act of moving its balance sheet around the world to different jurisdictions intraday, let alone from an accounting point of view, but they were doing it intraday. It was all to avoid balance sheet and capital restrictions that the regulators have put in place. So these kind of things, I think, scared the governments and they scared the authorities, and a lot of pressures now being put on those low threshold jurisdictions to come back into the fore. So I'll do my little EBC pitch here, but EBC is a group that has regulation in the UK. We have regulation in Australia. We've just been regulated in the Caymans. So the UK and Australia, you can see why that would make sense. Why would we go to the Caymans? Well, the fact is that we have offshore jurisdictions within the wider group, but we're looking to future-proof ourselves. So all of those pressures that Sarah talked about the innovation from governments to kind of stifle this avoidance, is true of regulations as well as the fiscal side. So we opened an office in Caymans because we understand that going forward, having banking, having authority to interact with people from different parts of the world within those jurisdictions is going to get halved out by the central banks and by the governments. They're going to close it down. So people like us, we take the hard decision at the beginning now to go to somewhere like the Caymans, which is very similar to the FCA in terms of its regulatory regime. And we do the hard work now, because by the time everybody else works it out, there's going to be a stampede and the door will be much smaller. So I think that realization and pressure that Sarah was highlighting in her slides is becoming real to the world. And just quickly to talk about small firms. So small firms are at a huge disadvantage in this, and it will tie into a quick comment about the minimum tax as well. If you're a small firm, the cost of existing in the world that we're in now, it's not just a fiscal cost, it's also a time cost. So you need more people, which feeds into that fiscal cost as well. The level of financial oversight and regulatory oversight now, I've been in the markets for 35 years and I've never seen anything like it. It's just obtuse, and it makes it extraordinarily difficult for anybody to really compete that hasn't got a scale of size, even to the point where we, as a company that's set up in the UK, we have to take into account with the regulator and the authorities here what we do in the Caymans. All of that reporting is a dual reporting. And just quickly on the minimum tax, because I know Sarah was talking about it towards the end there, I personally think it's a good thing. I think it's positive. I think that anything that undermines that financial slot that those big multinationals have carved out for themselves is positive. I think that it may help firms to do more interesting things rather than just avoiding tax. They may spend money socially rather than pay the tax in that way. It may be a positive. I think you have to be careful what you wish for. Implementing these things is always harder. As soon as you set a set of rules, particularly in the financial world, as soon as we have goalposts, we work out how to go around them. And I think that, things like Brexit, which whether that's your choice of what we should have done or not, it's clear that the lack of planning and the implementation of those changes was incredibly difficult for everybody. So, for me, a global minimum tax is a good thing, but I really think you should be careful what you wish for in terms of how you make it work.
Great, thank you so much, David. So much food for thought there. And actually that your kind of ending comments move us really perfectly on to a couple of the themes that are coming through on the questions. So thank you so much, everyone, for questions. I'm going to kind of group a couple of them together so that we can kind of get through a couple of things before we end. So on this kind of point about be careful what you wish for, there are kind of two sets, I would say, of kind of points on this in the Q&A. One around your point on regulatory arbitrage, which I know, both you and Sarah sort of have kind of hinted at, but thinking both in terms of what types of other regulations can you imagine that countries could start competing on, or to what extent might, if a global minimum tax is only applying to a particular type of asset or income class, could that create kind of spillover effects in terms of how companies are behaving on other parts of their balance sheets? And so I just wanted both of you to get kind of your thoughts on where would you look, or what would you, if you were kind of thinking about, I guess from the policy or the business side, where would you expect to see perhaps some of these be careful what you wish for effects coming out first, or that might be too much to ask?
Sarah, you go first.
Okay, yeah, no, sure. No, I think this is a super interesting question, and it goes a little bit back to talking about these loopholes that I was mentioning that has been highlighted in these this specifically this global minimum tax, and so there are a few things that are maybe problematic. So for instance, there is one, it's called the substance-based carve-out, which essentially means that there are ways in which companies can go to a tax that's lower than 15% if they put enough real economic activity there. So essentially, part of your tax base is deducted if you have real economic activity. So based on your payroll, based on your tangible assets. And there are people highlighting that what's going to happen is that firms are just going to put more real activity into places with lower tax rates. And that's going to mean that high tax countries are going to lose jobs, or going to lose investments and real activity. And that's going to be, so it's not just the revenue implications, but it's actually also going to affect the labor market and all sorts of other things that trickle down into society. And there's some technicalities, so this starts a bit higher and it becomes a bit lower, this deduction over time. But at the moment, it still looks like that's going to be in there. And so that's really one thing that I think is going to be, that we're potentially going to see effects on. Just very quickly, another one is, so there are certain things that are not included in these rules. So for instance, tax credits, if they're refundable, so yeah, are not actually included as negative taxes. And so countries could start competing on refundable tax credits or subsidies to firms, which are not in a way accounted for with these rules. So there are definitely ways that we can think firms are going to respond here. And it's very hard to predict how that's going to look. But I think one thing I just want to highlight from what David said is I definitely agree that this is really complicated, and it's becoming more and more complicated. And especially if you think about small, young firms, I can imagine that this would, I mean, of course, they're not included in the global minimum tax, but in general, I can imagine that this is it's becoming a very hard system, I would imagine. But yeah, David, your thoughts.
I couldn't agree more. I think everything you've said is true. The only thing I would question is you kept using the word could, as it could happen, it could cause problems. It will happen, and it will cause problems. Because unless you've got every single jurisdiction in the world signed up and there is an efficient system of implementing it, it's going to cause chaos originally. So, to me, if you'd looked at Brexit, it would have been perfectly reasonable to think there was a 5-year period of, I'll use the word adjustment because it's polite, but this on a global scale is going to have a much longer lag time in. It's going to be much more complex. Everybody is not going to commit to it, and there will be arbitrage in terms of jurisdiction and the rules and the regs. There's just no doubt about it at all. And the problem that you have in the modern world, particularly the financial world, is as soon as you set a set of rules and put it on paper and give it to the market, that's perfect for us because we just find ways around it. So if you look at the FCA learned this about 5 or 10 years ago. They have a rule book, but they don't have rules in it. They have ways that they expect you to behave. They have ways that they expect you to act. And it's a much more effective way of doing it because they can interpret the way you've acted in the way that suits them. Rules are there to be broken, particularly by financial markets. And money doesn't talk, it screams. I mean, it just looks for the easy way. And I think by being careful what you wish for, you really do need to be, because that complexity that we've both talked about all the way through, it really is difficult. And if you make it more difficult, it's going to be even easier for people to arbitrage their way out of it. And I don't think that's a discussion point. I think it's a fact. I really do.
That's really nice because it actually there were another couple of questions around the role of like kind of tax planning in all of this, which I think kind of like speaks to your point about there can be actually sometimes issues in this area around transparency and clear rules, because there's a lot of money which can go into thinking about how to avoid them. There are another set of really interesting points around to what extent do the two of you think that digitalization and the fact that more of our transactions are being captured and more of global transactions and multinationals' internal transactions are being captured online, like, do you think that like the impacts of that have already filtered through into how have we seen the end of that already, or do you think that's changed the dial at all in terms of either making tax evasion easier but also making its detection easier? Do you have any thoughts on that point?
I think from my perspective, I think it will help, because I think if we look at the regulators our interaction with the FCA, for example, they collect a huge amount of data, even from firms like ourselves, let alone big multinational banks that are regulated by the PRA. So I think it does help. And I think that the innovations we see in AI will help them not only gather, but interpret that information. But the reality is, it's only as good as the information they're given. It's only as good as the way that they interpret it. And again, if there are jurisdictions that do not require the same level of clarity, then your ability to capture the full picture and understand what's really going on rather than the bit that's right in front of you, I think is much smaller than people appreciate.
Yeah, and I think like one thing also to just mention is when talking about digitalization, I think like the emergence of very big digital companies have also been a driver in this historical development that we're seeing of tax evasion, right? So there's in this historical picture I showed you, there's a big uptick in like the start of the 2010s, and it's very hard to prove what's causing this, but I think a lot of it came from the change in how we do business and how hard it is to essentially regulate this. And I think it all also comes down to what is it that we're trying to tax in a way, right? So if we think that taxing rights should be where activity takes place, then, well, what is activity when we think about a very big digital firm? And there's a lot of thought going into this as well, also in the OECD process of thinking about specifically how do we do that and how do we deal with that? I think that's an important point as well.
Just very quickly, I think that's not just something for this conversation. I think it's for society in general. So it's very easy to decide what you like and what you don't like. And normally to make that differentiation, you have to draw a line. The difficult part in the world we live in, particularly because it's governed and driven by social interaction in a myriad of ways now, is where do you put that line and who agrees where that line goes? And it's true for something as archaic as a tax system as it is for social media, or the way that people are allowed to voice the way that they feel about something they don't agree with. I think it's not difficult to have a view. It's not difficult to say that there should be a line, but choosing where that line is incredibly difficult, I think, socially and practically.
Yeah, especially that as you say, socially, that different countries can legitimately have both different objectives and also different starting points. And the final thing that we'll end on, because we're actually already out of time, is just there was a couple of questions around equity, especially in this context of perhaps developing countries, and what strategies do different countries have in order to attract new business. And from your perspectives, I mean, is something like a kind of how much do these things in reality do you think interact in terms of giving developing countries enough flexibility to actually set the tax systems which they think of as competitive in order to grow their economies? Do you think that's a real trade-off, or is actually a lot of this idea around kind of benefits to local economy perhaps overblown?
Well, I do think it's overblown, but I think that the world is now, it's true of many things, right? The system that we've built up, whether it's financial, social, or political, the system we've built up has been for the benefit of the people that built the system. The problem you have now is that the ways that that manifests itself, so we talked about offshore jurisdictions and tax evasion, for example, has become so widespread and so complex that your ability to actually reel it in is much less. The world has realized that they've unleashed these monsters in all these different places that you've identified, and they've now worked out they've got to do something about it. But as we're discussing with the minimum tax rate, it's incredibly hard to actually do it. And I think that it's all very well for the virtual signaling of we're doing this for the greater good of an island in the middle of an ocean because it's good for them. They're not doing it for that reason at all. They're doing it because it's good for them and it suits them. And the positive impact on the little guy, whether it's because of politics, whether it's because of finance doesn't care about anybody apart from itself, right? So, the reality is that everybody signals the benefit of this from their perspective rather than from a real world perspective. If you really want to change it, you're probably going to have to break it and start again. And I'm not quite sure how you do that. So That's another
Yeah.
podcast.
Yeah. Yeah, I mean, just very quickly, since we're out of time, but I completely, I think there is a tension there. There are very serious equity concerns in general around tax evasion, not just in this context, but like in general. And there is this tension between countries having self-determination, but also having the global cooperation. I think one thing that I think is important to say that there is that if we allow for these practices to happen completely unchecked, that essentially means that countries don't have self-determination, because even if they want to tax it at a very high rate, they won't be able to, because it's going to move and it's going to go. We're basically going to have this race to the bottom that we've been seeing, where statutory corporate tax rates are being slashed and becoming lower and lower globally. And so I think there is a tension there, but it's not clear that we're losing self-determination by cooperation. It sort of goes both ways.
No, I agree. And it comes back to where you draw the line, right? How you decide where the lines are. Very hard. Yeah.
Well, thank you both so much. That was fascinating and incredibly useful. So thank you. We're gonna be ending this webinar there. But again, thank you to Sarah, thank you to David, and yeah, please do join us again for a future episode. But also the recording of this and the slides will be made available on the department's website and YouTube channel. So thank you again. Bye.